For most of this century, we had a kind of your typical relationship between risk and risk-free assets, between stocks and treasuries, where you have a negative correlation. Something bad happens in the economy, expectations, then you have flight to quality, and that has worked well as diversifier. And then we had inflation. And the inflation changes this correlation. It changes the sign of the correlation. So now, when the inflationary expectations drive the market concerns, you have a positive correlation between bonds and stocks, and that obviously does not work well for diversification when you need it the most, and that's what we witnessed in the early 2020s. So now the correlation kind of went back to zero. It's unclear where we go from here. But does this mean that traditional 60-40 allocation, or the allocation to a treasury sleeve as a downside hedge, is dead? I really need to be looking about that differently. So, Mark, perhaps we can start with your perspective on that.
Sure. I wouldn't necessarily say it's dead, but maybe it's intensive care. I've been in the industry for several decades, and right now I've seen this slow process of people going from purely stocks and bonds at 60-40 and moving more towards alternatives, right? And it could be private equity, hedge funds, commodities, managed futures, real estate, private credit, whatever it is. But there's a very wide spectrum of where people can go. One of the things I look at, and actually my dissertation, I focus primarily on CTAs and hedge funds and their correlation, and how do you use that as a tool within your framework of asset allocation decisions. So you can make an argument for any of these assets to be in your portfolio. The question is, what's the goal of the investor, or what's the mandate? What's going to fit their portfolio best? So if you look at just, let's say, hedge funds, there's a lot of different strategies. For years, I would hear people say, or an investor say, I'm in hedge funds, therefore I'm diversified. Not necessarily. It depends on which of the strategies you go into. Some are more heavily correlated to equities, some are more diversifiers. So if you look at that, if they want an extension of their equity exposure, they go to the ones that are more heavily correlated. If they want more diversification, they go towards the bottom that are least correlated. And if you start looking at that method, that starts to give you a better idea as to where you can go. Now you can take that then beyond hedge funds, take it to other strategies. But if you think about just generally, there has been this increasing move towards alternatives and going, there's much more out there in the world beyond stocks and bonds. As a professor, because I also teach it at DePaul University, one of the classes I teach is on alternative investments. Most of the students know nothing about it, right? They come into class, they know stocks, they know bonds, but they don't know about any other asset classes. And they start to learn about it and go, this is really cool. There's all these other places we can go and potentially find opportunities.
Well, I fully agree with Mark. The most important thing for the investor is to understand what he really wants from his portfolio. The goals have to be very clearly understood and articulated. Without it, we can speak about asset allocation all day long, but it's pretty much a useless exercise. When we look at the landscape of US investors, especially US institutional investors, we can see that 60-40 is pretty much alive, unfortunately. Not because people know what they want from their portfolios, just because of legacy reasons. Unfortunately, it very often happens that the level of competency in those boards and investment committees is insufficient for diversifying properly. Do they need to diversify? Yes, absolutely, because 60-40 is a thing of the past. Most of the risk in your 60-40 portfolio is concentrated in equities, because equities are significantly more volatile than bonds. And they do need to add something to make their allocations more stable, to increase their solvency ratios, and so on. What we have seen, however, and what Stas alluded to, is much of the alternative allocation has gone to private equity and private credit. Private equity is still equity. Private credit is still credit. And for many people, allocations to those private assets are justified by the absence of volatility, or perceived absence of volatility. This is outright wrong. When you have private equity, you still have volatility. It's just this volatility is hidden from you. You are not seeing it. It's not marked to market. But nevertheless, you don't assume that when you have stocks of, I don't know, Microsoft, they are volatile. You have a share in a private software development company, which is like 1 million times less than Microsoft. You have no volatility. This is ridiculous. So I think that when you think about diversification, when you think about alternatives, you need to think about what you are actually buying and how it's going to help your portfolio achieve the goals which you have understood and articulated.